Let's look at the application of expected value in insurance policies. Okay, so an insurance company sells term life insurance policy for a 20-year period. The amount payable if the death occurs is $75,000. The company's actuary has calculated that the probability of death for a 30-year-old man over the next 20 years is 0.017, and that a suitable premium is 2,000. What is the insurance company's expected gain if it sells one of these policy to a 30-year-old man? So let's understand what this story is about. So now this is, say, a 30-year-old man, and this is the insurance company. Okay. Now, what is a life insurance policy? So let's understand what it means. Now, this life insurance policy is a contract between a policyholder. Suppose here this is a policyholder. Suppose this person is interested to, this person is the person who bought the life insurance. So the contract goes like this. This person promises to pay, say, $2,000, which is the premium year, 2,000 as premium to this company, and say I am insuring myself from death. So what does that mean? So this amount is the cost or the charge that the insurance company takes from this person, and this insurance company promises, what does it promise? It promises in return that if death happens, so it's a conditional agreement. If death occurs or happens, we would pay your family or your next of kin $75,000. And if death doesn't happen, this amount would not be refunded. So this is a contract between this 30-year-old man and this insurance company. Okay, so let's understand the maths behind it. So the insurance company does do maths before calculating the premium. Okay, so what are they saying? The probability of death. So let me write probability of death. If the probability of this person dying within next 20 years, or actually this is a term insurance policy, so this is only for 1 year. So once you pay the premium, the contract runs for one year, and if that death happens, you have to, the insurance company pays $75,000. So the probability of death of this person is 0.017. 0.017. So if the probability of death is this, the probability that a person would be alive would be 1 minus this number, this probability, 1 minus 0.017. I hope you understand that, because 1 is a certain event and this is a probability of the person dying. So let's use the calculator. So this is 1 minus 0.017, which is 0.983. So the probability that a person is alive, or that person is alive, is 0.983. Okay, now what is gain for the, let's talk about gain for the insurance company. We're talking about the gain for the insurance company. So the person, okay, the gain would be, there are two types of gain. If the person is alive, okay, the gain would be the total $2,000. The gain would be $2,000. And if the person dies, okay, if it's death, it would be negative gain. So you would have, you have already charged the premium, and you have to pay the insurance amount, which is $75,000. So the gain is minus $73,000. The gain is, so there are two scenarios here. One is you gain the $2,000 if the person is alive, or you lose $73,000 because this is the premium amount, take away the insurance amount. Okay, so let's make up two columns. So the gain, so let's call gain as the random variable x, and the probability of x is equal to x. So there are two gains. One is, say, 2,000, One is the person is alive, you gain 2,000, or it is minus 73,000 when the person has died. Okay, unfortunately. So the probability, the respective probability of a person being, so let me write here. Suppose this is for alive, the person is alive. There are two scenarios here. So this is one is alive, and this is when the person has died, if death occurs. So the respective probability for the person to be alive is 0.983, and the probability for a person to die is 0.017. So the expected gain, so E of x, as you know, would be sigma x from 1 to n. This is 1. Let me use a smaller eraser. This is xi, x, this is I, runs from 1 to n. This is the general formula, 1 to n of xi times probability of xi. So here, what you have to do is you have to multiply this probability, this gain times the probability, and add to this times this. So basically what you do is, this is 2,000. I'll explain the meaning of this, times 0.983 plus minus 73,000. This is when the person has unfortunately died, 0.017. So let's get the calculator out. So this is 2,000 times 0.983 plus minus 73,000 times 0.017. So the gain is $725. So what does that mean? The expected gain for the insurance company is $725. Now, what does this number mean, or this amount means? This means if this policy is sold for a number of people, okay, for a huge number of people, on an average, the insurance company would gain $725, because when you're selling this insurance policy to a number of people, there are two outcomes. One is the person is alive, or the other possibility is the person dies. So if you, over a long period of time, if it's sold for a number of people, say for thousands of people, on an average, you can say the insurance company would gain $725.